Welcome to the Capital News. I am your host, Alex Kreitis. Today is February 27th, 2019. Thanks so much for joining me. Let's get straight into the economic news. We got a few good stories here I'd like to discuss today. S&P was down $1.50. The Dow was down 73 points. The Nasdaq was up 5, and the Russell 2000, the small cap index, was up 3.5 points. Oil, gold, and silver markets were little moved, even despite the fact that we have potentially some growing concerns of hostility between India and Pakistan, two nations that are armed with nuclear weapons. I said in my previous podcast on the political and geopolitical risks that we should pray for peace and that this becomes just a simple tit-for-tat retaliation. India had made an attack into Pakistani territory, or at least in Kashmir, which is a contested area, attacking a terrorist camp, and then Pakistan retaliated and shot down an airplane as part of the Indian Air Force. So hopefully it's just a tit for tat. This doesn't escalate to nuclear war or anything serious, and we can move on from that. But the markets, despite the fact that you have two nations with nuclear capabilities, there was no major sell-offs. There were no major sell-offs. There was no spike in oil, nothing to that nature. And I know I spoke yesterday about President Trump tweeting in regards to oil prices and telling OPEC to take a chill pill, calm down, all that stuff. And then we had the reversal in pricing in the oil market. Well, OPEC and Russia have come out and said, that it really doesn't matter. They're going to continue with their scheduled production cuts. So we'll see what type of effect that has on the price of oil. Again, you know my argument and my theories on what's happening. I just don't think there's going to be enough demand out there to really get that price up to where they might be hoping that it gets. North of 70, 75, somewhere like that. They might hit it. Is it going to stay there for a long time? I don't think so, unless we have one of these black swan geopolitical risks that come to fruition, and we do have this escalate in India or Pakistan or from somewhere else that we just don't know. But other than that, I think oil prices are probably they might have another little leg up, but I don't think it's going to be sustained on the back of slowing demand. The 10-year Treasury bond was up, now stands at 2.69%. It had a big day. It's up 2% for the day, so there was some selling in the Treasury market. Where did all that money go? I don't know, because it really didn't bid up stock prices at all. The S&P was down, the Dow was down, and the Nasdaq and the Russell were both barely up for the day. So where's all this money going into? And then lastly, the dollar was mixed against a basket of currencies. But I want to continue with our discussion on the housing market because we have another article out today from Bloomberg. Orders plunge as California buyers vanish. Well, that doesn't sound good. Toll Brothers Incorporated. New home orders dropped 24% in the first fiscal quarter, the steepest annual decline for the biggest U.S. luxury home builder since the depths of the housing crash in 2010. The company struggled to find move-up buyers in California, which is gripped by an affordability crisis. Analysts expected a decline of less than 15% in new home contracts in the quarter, which ended January 31st. Instead, it was the largest drop since the 27% year-over-year fall in the third quarter of 2010. An improvement in margins provided comfort for some investors, but they were based on contracts signed 9 or 6 months ago, before the market began cooling, said Bloomberg intelligence analyst Drew Redding. Orders fell 62% in California, where Toll has a heavy focus. Toll shares fell as much as 3.3% and traded at $36.74 in New York, down 1.4%. It was worse than anybody was looking for, Redding said in a phone interview. It has become very clear that the higher end of the market has been weaker than the lower end. Also in December, there was stock market volatility, and a lot of Toll's buyers are purchasing their home with investments rather than monthly paychecks. That's very important. They were buying these homes with their investments rather than their monthly paychecks. Toll Brothers is especially vulnerable to the housing slowdown, which has hit the higher end of the market where inventory is greatest. While mortgage rates have come back down, they jumped last year, exposing an affordability problem that built up over years as prices outpaced incomes. It is especially bad in California, where sales are falling, making it more difficult for tool buyers to sell existing homes to buy new ones. Alex Barron, analyst with the Housing Research Center in El Paso, Texas, said that California orders likely took a hit, in part because Chinese buyers are getting scarce as China tightens controls on capital outflows. See how everything is connected, ladies and gentlemen? This is not just an issue for Toll, but for anybody selling homes to the Chinese. Barron continued. The company said that non-binding reservation deposits, which it stopped reporting in previous years, saying it was an unreliable indicator of demand, were down from a year earlier, but it said the last week's deposits were better. We attribute the decline in our first quarter contracts to a difficult year-over-year comparison, a lack of current inventory in certain locations, and the industry-wide slowdown that began in the second half of 2018, Douglas Yearley, the company's chief executive officer, said in a statement. So here we have it, ladies and gentlemen, more negative news, and this is negative news in a very significant portion of the U.S. economy, which is housing. Now, this is more so affecting the upper end of the real estate market, and let me tell you in part why that's the case. It's in part because we have all of this money printing, this funny money that comes into the system, and I tell you this every single day, so I hope that these stories that are starting to come out in the media, this stuff is starting to come to fruition, okay? These houses were bid up because they had funny money. They were making this money not by their paychecks, according to this article, but by their investments. Well, we just had a 20% sell-off in the fourth quarter of 2018. It doesn't bode well for people's investments, does it? It might not bode well for their monthly paycheck either if they're tightly close-knitted or linked to the stock market, if that's where they make their living. So these people are running out of the funny money. Okay, so let me take a step back and let me go over this with you. So you have the funny money that gets printed by the central bank. It goes into the banking system. Some of the banks do their own trading with it. They get into the markets. They buy financial assets themselves. They have trading desks, stocks, bonds, currencies, commodities, everything. Then obviously they're going to loan some of this money out. Well, who gets it first? Big corporations, wealthy individuals. Well, some of these wealthy individuals go out and they buy big homes. And they bid these prices up because if there's only so much inventory and there's a bunch of money circulating, they're going to bid the price up for these houses. That's why you've had astronomical pricing back at it in California, Miami, New York City. All these markets, again, are becoming overheated, and now we're seeing a sign of this because we have orders plunging in California as buyers vanish, as the article states. And it also stated that you're seeing a reduction in foreign buyers, particularly the Chinese, because they are in trouble, ladies and gentlemen. Don't believe their government statistics. You shouldn't believe Chinese government statistics. You shouldn't believe ours. You should look at everything with a grain of salt and dig deeper, and that's my job here, to do that for you and to bring some sense and truth to the whole situation. So what becomes interesting in this housing market decline, will it be a crash? I don't know. I wouldn't be surprised, but I'm not going to speculate and give everybody a date and time as to when it's going to happen. But if it does happen, I'm not going to be surprised, okay? But here is how I would see this unfolding. During the last crisis, it really all started with subprime. Again, because there was a bunch of funny money that existed, and this money, the banks were just awash in liquidity. They said, well, where are we going to put this money now? They said, we have an idea. Let's put them into subprime mortgages. Let's get anybody with a pulse into the bank and tell them, yeah, you can live the American dream. You can afford this house. No, you couldn't, but that's what they told you. It was fraud. They knew it, but they didn't care. They were collecting huge fees, huge commissions, and they were having the party of their lifetime. Average Americans, be damned. And that's what happened. Average Americans were damned. And who got the bailouts? The big banks did, okay? You can't make this stuff up. Who went to jail? One guy. Low man on the totem pole some years after the fact. Didn't even have anything really to do with this. So here we are again. This time, however, instead of it being in the subprime market, it's now at the high end. Why did it go to the high end this time? Why is it more tilted that way? because we have laws that were enacted after 08, 09 crisis and said, look, you just got burned. You can't be doing this. You can't make these types of loans to these types of people. They're not creditworthy. They just can't afford these homes. The prices are too high. It just doesn't make financial sense. It didn't make financial sense before, but now they got smacked. The world got smacked, and so you're learning your lesson. The regulators come out and they say, okay, you can't do this anymore. And then the banks learn their lesson. They say, we don't want to do this anymore. So now the money has to go somewhere else. Well, now it's going to the high end. So the same thing that happened at the low end, and a lot of houses got bid up. You had astronomical housing prices. Now you have really astronomical housing prices in the luxury end of the real estate market. Okay? This really makes perfect sense. The money has to go somewhere. It gets directed, and a lot of that has to do with government policies and regulations. It's a lot more difficult to lend to subprime borrowers. But don't worry, the banks are trying to do it because, again, they are awash in liquidity, and they're just trying to get rid of it. If banks don't make money sitting on cash, they make money either by investing it or by loaning it out to businesses and to individuals to start businesses, expand their businesses, buy homes, all that jazz, right? And that's what makes sense. That's what the financial sector is here for. The financial sector, in its optimal form, is supposed to be a lubricant to the economy. It's not supposed to serve as a point of friction. But we see more and more as the banking system gets bigger and bigger and bigger and more interconnected with everything, it really sets itself up not to be a lubricant for growth and expansion of the economy, but really a source of friction and pullback. And as we saw in 08-09, it can really devastate the global economy. So I would not be surprised in this case if we see a top-down crash, or at least major decline in real estate. And then because you're going to have these issues at the top end, that will eventually make its way through the real economy, which will translate into layoffs, job reductions, everything, a reduction in overall demand, which again will trigger more layoffs, lower demand, and then you will see a problem with the lower end consumer, subprime, near prime borrowers who have homes, who can't afford to make their mortgage payments because they were just laid off, their businesses aren't generating as much money as they were. This is all going to happen. The question is when, and the question is its severity. So last time we had a bottom-up collapse. This time I think we're going to have a top-down first, and then the bottom's going to come up, and it's just going to squish the middle, if that makes sense. You're going to have the high-end real estate market, and then once those real effects make their way through the economy, you're going to have people on the lower end not being able to make their payments, and so you're going to have another problem in that market. So it's a top-down, bottom-up squish. It's just going to sandwich everything, and it's not going to be good for the housing market, and it's not going to be good for the broader market at large. We just went over the Home Depot report yesterday. Their shares were down, not giving good forward guidance. Everything is connected. That's what I'm trying to get across in this program. Nothing is an island. Everything is connected. You're talking about California housing, and you're talking about China. I mean, it's amazing. This is a global economy. And they don't want the Chinese, I'm saying here, the Chinese, because they have some serious problems that they're dealing with, are coming down on capital outflows. I've stated here previously, they are looking to double capital inflows, direct foreign investment. They don't want the Chinese going anywhere abroad anymore, which is what they were doing. And a lot of the Chinese who went abroad were smart because they damn well know that they are living under a communist regime, and when you know what hits the fan, they damn well know that that government is going to just seize bank accounts, stop that money from leaving the country. So the Chinese who are smart and were going to Australia and Canada, who have extremely elevated housing prices, have also made their way to the United States, in California, in Florida, in Illinois, in New York, all across the country. They love real estate. They love real estate, and it's a good place to park your money if you got a lot of money. So things are starting to slow down. Pay attention to this stuff because it's important. Yeah, you might not live in a high-end real estate market, but that doesn't mean that it can't affect you. And believe you me, in a short order, it will. Now, moving on, Ray Dalio, and I've mentioned Ray Dalio's name before. He is the founder and co-chief investment officer of Bridgewater Associates, one of the largest hedge funds in the world. I believe $160 billion in assets under management. And here is a brief article I want to read to you from Yahoo Finance, titled, Ray Dalio has lowered his odds of U.S. recession hitting before the 2020 election. Hedge fund titan Ray Dalio, the founder of $160 billion Bridgewater Associates, is less worried than before about the odds of a recession happening in the U.S. before the 2020 presidential election. While I still expect that there will be a significant slowing of growth in the U.S. and most other countries, I have lowered my odds of a U.S. recession coming prior to the U.S. election to about 35%, Dalio wrote in a LinkedIn blog. Just 18 months ago, he set the odds of a recession above 50%, arguing that the Federal Reserve's tightening in response to the U.S.'s growth spurt would send stocks and ultimately the economy down. And while speaking at Harvard in February 2018, he reportedly said the probability could be as high as 70%. Because the markets weakened and Fed officials now see that the economy and inflation are weak, there has been a shift to an easier stance by the Fed, he writes in the new blog post. Similarly, because of weaker markets, economies, and inflation rates in other countries, other central banks have also become more inclined to ease, though they have less room to ease than the Fed. Dalio noted that the Fed can lower rates by more than 2% to put off a recession, but probably doesn't have enough firepower to offset a deep recession. He added that he remains worried about economic weakness in other parts of the world like Japan and Europe. So here we have it, a market, how you want to put him, legend. He really is. I mean, you don't have $160 billion in assets under management by not knowing what you're doing. I give the man a lot of credit. That's why I talk about him in a few other podcasts. He is, to me, an economic and financial historian. He seems to be very balanced. He is known for diversification. So when he talks, I tend to listen. It doesn't mean I follow everything he says. I really don't follow everything anybody says. But when some of these guys speak, it's I think it's proper to take note of what they're saying, because it might not be exactly what they're saying, but if you can read in between the lines, I think that's really where the information becomes valuable. So here he's saying that the economy and inflation are weak. That's him saying this. No, that's not what we're told from the White House. That's not what we're told from Larry Kudlow. That's not what we're told from the President of the United States. Everybody and their mother knows that this economy is weak. Are there some good parts of it? Sure. There's always bright spots in any economy. But the overall trajectory is not in a good direction. Have there been some things that have been a positive? Yes and no. You have the tax cuts, but that blew out the budget. So you're not going to cut spending. I don't know if it was prudent to really be doing those tax cuts. So I'm always for tax cuts, but you got to cut some spending on that too. Okay? Now, Mr. Dalio, because I've listened to many of his interviews and talks that he has given over the past few years, he knows what's going on here. He knows what these central banks the world over are doing and have been doing. He knows who butters his bread. Okay? He doesn't want these guys to increase interest rates. He doesn't want the balance sheet runoff, because this has made him a lot of money over the past 10 years. Okay? He didn't have to be a genius. He didn't have to be the man of diversification. All he had to do was sit back and let the Federal Reserve do all the money printing that they were doing, and financial assets, which is what this man invests in and owns, was going to do all the work for him. Now, did he and his team go in and pick some better investments that may have allowed them to beat the market? Sure. Sure, that's what they're supposed to do. But you get what I'm saying here? He's coming out and saying, well, the economy's weaker, inflation readings are weaker, there's really no reason for the Federal Reserve to continue to tighten. So now he is lowering his recession forecast. I'm not so much concerned with his recession forecast. I mean, you're out. It might have been 70%. It was 50%. Now it's, 35% before the 2020 elections. I don't care what these people say. And even if I throw some number out at you like that, just, say, Alex, you don't know what you're talking about. And I'm not going to be offended, because when you throw these numbers out, they're just all likely to change because there's so many moving parts. There's just so many moving parts. I mean, at some point, there's going to be a recession. So you can say 100% there is going to be a recession. Putting a time frame on it is what becomes more and more difficult. But you have to start reading the tea leaves. Okay? You have to start preparing yourself for what might be coming. There's the risk-reward trade-off. What's most likely to happen, and do you want to protect the capital that you have earned and saved and invested and made, or do you want to keep that at risk and really potentially have a 20% plus decline? Because it can happen very quickly, as we saw in the fourth quarter of 2018. And lastly, with this Ray Dalio article, he's still concerned with Europe and Japan, which he should be, which is a perfect segue for my next article that I want to read to you guys, because I was watching Bloomberg Business News last night, and there was a story that came across that was just a blurb that said the Bank of Japan is going to continue to purchase ETFs, exchange-traded funds, for the Nikkei, the Japanese market, and they're going to continue to do so even if they incur losses. They just don't care. They just want to print money. They just want to keep propping this thing up. So let me read you this article from Newsmax. And I'm probably going to have to do a couple podcasts on this, because this is what this whole program is about. This is what I have been saying since I started this podcast almost a month ago already. And it's just one thing after the other. But this one is really telling. So here's the article from Newsmax entitled "Central Banks Plunge into Stocks is Flashing Warning Sign." Once upon a time, central banks' purchases of common stocks were non-existent. In recent times, however, a 2018 Reuters article observes that stodgy central banks have moved into the fast lane of the investment world. Lately, central banks have been doing the market equivalent of zipping around in a sporty convertible. In recent years, at least two large central banks have been snapping up large quantities of equities, typically considered a risky investment. The two most prominent convertibles are the Bank of Japan and the Bank of Switzerland. The Bank of Switzerland now owns $8.8 billion with a B, $8.8 billion in U.S. technology stocks. The Bank of Japan's voracious appetite for Japanese exchange-traded funds also did not abate with the Dow and the Nikkei's October highs. In fact, the bank bought a record $7.68 billion in October, apparently aiming to support equities. Central banks obviously feel safe employing this policy, and the public finds a reason to feel safe because of it. This is just not good logic. The Elliott Wave theorist, which I believe is a newsletter, puts the central bank equity plunge into historic perspective. Figure 1, if you saw this thing, what a beauty this chart is, let me tell you. Figure 1 shows stock purchases by the Bank of Japan and the Swiss National Bank back to 1949, when the Bank of Japan was restructured along current lines. Note that for half a century, central banks did not buy any stocks. Then, shortly after the peak in the S&P 500 in 2000, they revved their engines. Take a look at this article, ladies and gentlemen. I mean, they revved their engines, believe me. Wall Street on Parade estimates that more than a dozen central banks have begun buying publicly traded stocks in the last decade. How have the banks fared so far? Not well. Based on this recent Wall Street Journal headline, "Riches to Rags, Swiss Central Bank Swings from Record Profit to Large Loss." The Swiss National Bank itself is a publicly traded company, and the price of its stock has plummeted from just under 10,000 Swiss francs to 4,000, a decline of nearly 60%. The stock of the Bank of Japan has done even worse. Get this, ladies and gentlemen. After peaking at 740,000 yen at the top of the Japanese bull market in late 1989, it has slumped to 37,000 yen. 740,000 yen at the top to 37,000 yen where it stands. Unbelievable. This is what I'm telling you. This is the whole charade with central banks. This is why I've been telling you now why the Bank of Japan is in charge of a zombie economy. 30 years now, 1989, and they are nowhere close. 740,000 to 37,000 yen. That's ridiculous. The article continues. What happened to make these two banks take the plunge into equities? We believe the cause was the psychology driving a multi-decade bull market. Elliott Wave Theory editor Robert Prechter explains, acting just as the odd-lotters of olden days, central bankers became confident near the end of the run that owning stocks was a safe bet and a good idea. Note, another group with a well-documented history of buying high and selling low is foreign purchasers of U.S. shares. This is what I was telling you yesterday. You want to buy low, sell high. These guys are buying high and probably going to have to sell low. Not good. Such histories have not deterred central bankers. A Forbes article on January 16 reported China's central bank will prop up country stock market. China's PBOC, that's the People's Bank of China, will buy local listed shares to prop up a stock market that's down over 25% in the last 12 months. If things get better, China can outperform with the central bank's support. As Prechter noted, the idea that central bank buying can force a bull market is so entrenched, it's taken for granted. We believe that the ramped-up commitment of foreign and domestic stock purchases by central banks is not the ultimate bullish sign that investors believe, but rather one of great bearishness. I couldn't agree with that last sentence more. If you have a strong economy, and if you have a strong national economy, a strong global economy, you don't need this type of quote-unquote stimulus coming in from central banks who are creating money out of thin air to buy equities. This is a fraud. Plain and simple, this is a fraud. They are propping this thing up. They evidently know how bad it is, and they don't care. Nobody wants to come out and be a leader. Nobody wants to come out and say how to solve this problem, because the real solution to all of this, ladies and gentlemen, is to abolish central banks and to get rid of income taxes, because it's theft on its face. It's direct theft from the taxation of income taxes, and it is indirect taxation from inflation, which happens when you have money printing. And when you have it like it has been, the pedal has been to the metal for 10 years. 10 years. You finally start to have central banks tone it down, come down a little bit, and bam! Q4, 20% decline. It doesn't take much to prick this bubble and to blow it up. And I think central bankers around the world are starting to realize the monster that they have created is not going to go back into the box. And there's nothing that they can do about it. And this goes back to one of my biggest concerns on that list of 30 market risks of 2019 that we have discussed here that was provided by Deutsche Bank. And what was it? It had to do with the effectiveness of central bank quantitative easing. If they were to redo quantitative easing as opposed to this supposed quantitative tightening, what are going to be the effects? If it's not effective, then what tools do they have and what tools would the governments have to stimulate the economy? Silence. I know, because there is none. It's game over. Game over until all of this stuff is just simply deleveraged. The amount of pain that will cause is going to be devastating. It will make 08, 09 look like a walk in the park. I have no doubt about that. But I can't give you a time frame as to when that's going to happen. I just can't, because they've manipulated these markets for quite a long time, but to a huge degree over the last decade, as this article illustrates, as the other podcasts, I hope, have illustrated to you. This game of musical chairs is going to come to an end. And let me tell you, there's going to be a lot of people without a chair. I'm going to continue this conversation with you guys because I want to look into this more and continue to educate everyone the best I can and to further educate myself as to what's likely to happen, because we can't do this. This is fraud on its face. You got the central bank, the People's Bank of China, propping up their stock market. The Bank of Japan propping up their stock market, and they don't even care if they lose. I told you in previous podcasts that there's record loans out in China because they are trying to prop this up. If something needs propped up, it ain't good. Thanks for joining me, ladies and gentlemen. It's been a pleasure having you. Please like, share, subscribe, get the word out, leave your comments. I would love to hear from you. This is the Capital News. I am Alex Coraitis. Godspeed.